Tom, in terms of downside protection, what can we offer clients on our book?
Lee, downside protection is what every investor is worried about. And I need to distinguish between two types of downside protection. The one is a normal retracement in a bull market where you can lose 10, 15, 20, maybe even up to 20% of your portfolio value. And that most investors can actually stomach. It's not a problem over the long run. You make it up in 1, 2, or 3 or 4 months. But the one that keeps a lot of investors out of the market from ever investing in equities is a market crash. When the market goes down 40 or even 50%.
And panic sets in and all of a sudden they start closing out.
Yes, and they tend to close out right at the bottom.
Murphy's Law.
Murphy's Law.
Yeah.
They will do all the wrong things at the right time or the right things at the wrong time. So it is important for us to be able to offer our investors certain tools or certain hedging strategies that ultimately will protect them from the downside.
In terms of our fund, we've got several indicators we do look at in terms of downside protection. Can you elaborate on a couple that we do have? I know you refer to them as silver bullets.
Yes, Lee. Our first silver bullet is what I call the bubble indicator. And there we look at how value shares perform against the market. And when value shares underperform, in fact, not only underperform, but when they go down in value, when the market in itself is still rising, we see that as a leading indicator towards a big market correction coming. So when we see that happening, we will reduce the leverage in your portfolio and obviously try to position your portfolio that it is correctly positioned for a possible downward move.
Okay.
The second one is our market timing model. Now there we look at market valuation and market sentiment. And this is not the place to explain the technical details of that, but the output of that market timing model gives us a confidence figure for going forward during the next quarter. So our normal confidence level would, for instance, be 70%, and then we will assume your normal market gearing. But if the market valuation becomes cheaper, that means there's a better chance of making money in the market, then we will increase your gearing to 25% additional gearing or even 30%.
And hopefully capture that upside.
Yes, and we have a short-term version of our market sentiment indicator which also allows us to pinpoint the exact bottom of a local retracement. But in the bigger scheme of things, market valuation plays a role and long-term market sentiment plays a role. And when the perfect storm would be when the market sentiment deteriorates sufficiently to a point where investors start to panic. And at that point in time, if the market is still overvalued or evenly neutrally valued, that means there's no safety net in the market. And then you have the perfect setup for a market crash. Now, our market timing indicators track those two indicators very, very carefully. And then the output is a confidence level that tells us going forward during the next 3 months, how should we position your portfolio? So if we can see that we are now in the danger zone, then we will obviously sell all your shares and we will even go net short in the market. So yeah, that's the second silver bullet. Yeah.
All right. And the third bullet, tell me, obviously I do know we've now incorporated put options, which we'll speak about a little bit later. But the third silver bullet, you have mentioned market timing, bubble indicator.
The third silver bullet is indeed our put option. That's the first for South African retail investors. And technically speaking, a put option is a security that gives you the right to sell at a predetermined price, but not the obligation. And that means that you will never make a loss with a put option beyond the amount of money that you put in, because you're not forced to sell it at a loss.
Okay.
However, when your put option is in the money, that means when you're making money from it, you're making a profit, then you have the right to sell it at the profit, and then the market maker is forced to take the loss on his
Now,
side.
it might come across as, I'm sure, as it does to several investors, as quite complicated. In layman's terms, have you got something that you can maybe relate that to?
Yes, the best way to describe a put option is like buying insurance for your car.
Okay.
There's a premium you have to pay. In the car example, you pay a monthly premium, and you are covered at a certain level. For instance, you pay 1,000 rand a month for your car insurance, and you have cover for a 200,000 rand car. Now, for a put option, it works exactly the same. You have a certain amount of premium that you pay. It usually will be between 2 and 5% of the market value of your portfolio. And you have a cover that will vary between 20 and 100% of the market value of your portfolio. And we will change the weights of your put option in accordance with the confidence levels that we have. So if we are highly confident that we are going to make money in the next quarter, then you don't need put option protection. And of course, as the sentiment of the market comes down or the market becomes even more expensive, then we're getting into the orange or the danger red zone. That's when we will start increasing your put level protection. So that in the end, if we get to the perfect storm where the sentiment is so bad that investors are panicking, and at the same time when the market is still expensive, so there's no safety net nearby, then that's the right time to actually cash in your put options, collect the payout from the market maker, and that way we will protect your downside.
Okay, and like you said, it was about a 2 to 5% sort of sacrifice in terms of returns, but I think a very welcome addition to the fund in terms of downside protection.
Yes, to summarize, 2 to 5% positive return is what we will give up, but what you win is a 20 to 40% downward move that you will not be exposed to.
Exactly.